biggest challenges to our growth is first, and Louis sort of hit on part of this, but first is assessing demand. Because in the end, that's what this is all about. I've always thought, let's say you lived in Switzerland in some little village of 1,000 people that never changed. Now, other than demographic change of people getting older, moving out of houses in the smaller places, families moving into bigger places, you basically wouldn't have a need for any new real estate. So the reason why our business has been successful, and look at the Irvine Company, my gosh, is because of demand. We've had increased population in the West that causes a need for new stuff. So as long as you have the staying power, and you don't over leverage, and you're in a strong demographic market, eventually all of the stuff will get leased up. Office, retail, industrial, no matter what it was. And as it gets leased up, finally there'll be a demand for new stuff because rents will have moved on up to justify new construction. That's been the history of all of us in this country, in the Midwest especially. The problem right now is that you have in the US, and Louis hit on it, and all around the world, every single government is artificially stimulating their economy because they're afraid of the political ramifications, which are real, okay, of the fiscally mature, fiscally solid. Okay? So because everything is being artificially driven, it's so hard to tell what the underlying demand really is. It's like the game when you're a kid and the chairs with the music. And at some point, so that's the first thing, trying to understand demand. Because with all of us, to build a new project or to buy something, it's based upon the future and the hope that things will, we'll be able to lease that up and get high rates down the road, whatever. The second thing is the amount of capital that is sloshing around. Back to all the political issues around the world, the U.S. is the safest place for any investment. So as I mentioned years ago when the people in Hong Kong were worried about China taking over Hong Kong, imagine now. So two things. One, you have more capital in the history of the world out there, chasing investment returns, and a lot of it's politically motivated. So for us, I was talking to a broker the other day in San Francisco, well-known broker, not here today, was talking about how we should buy something at a 4 cap because we could probably sell it at a 3 cap. Well, we're an operator, as actually all of us are up here, okay? And you cannot buy properties, stabilized properties, at a 4 cap and operate them. These are like kids, they eat, they need roofs, they need asphalt, they need stuff. It doesn't work, it just does not work. Now that doesn't mean someone trying to bury some money doesn't have motivation different than an investor. So the second thing that scares me is how do we keep competing when first it's hard to assess demand, and second, you're competing against giant amount of money that oftentimes have different alignments. In other words, our folks, luckily we can afford all our folks. We don't have to do another deal. We don't have to buy anything or build anything. We have to operate what we've got. And sometimes the best deal you do is the one you don't do. And yet a lot of people with pension fund money, and this has been the history of syndicators and all those third-party folks, they're generally incentivized by buying something and selling something. We make our money owning. You make your money owning. You make your money, Mr. Brent, owning. Okay? So there's that misalignment, and when there's a lot of money putting pressure out there, that supply and demand, that keeps prices down unrealistically and makes it harder to compete when you know what your operating numbers are.
I was on a panel with Ned Speaker at the time that the Blackstone equity office deal was coming together, and Ned was the biggest single shareholder in equity office. And somebody from the audience asked a question, what he thought about the pricing that Blackstone was paying for equity office, and he said, the guys at Blackstone did a feasibility study. They studied the deal and determined without fear of contradiction that they could make a fee, so they did the deal. Gives whole new meaning to the term feasibility.
When I get there, when I was in college, it was like, okay, where can I get a job? And I'll just, wherever it is, that's where I'm going. So I think, to me, it would just be, can you imagine how productive it would be here if we fix the state politics, if we fix the.
Well, now we're dealing with dreams.
So in spite of that, our customers absolutely want to be in California, and the Irvine company is, it's a California company. We are, with a few minor exceptions, we are not outside of the state of California.
Even I could make money if you started out by giving me Orange County. And I'm old enough to remember when it was a farm.
We've had properties in California since 1954. My father bought the Claremont Hotel. California is an amazing place. And at the same time, there's no perfect place. We can talk about Puget Sound. My God, is it amazing. I mean, San Francisco, I mean, LA, I mean, Sacramento, I mean, all the markets we're in. I've been on soapbox for all of them. I think there's a bigger issue, though, and that is the millennials. And, you know, the East Coast was settled first, so they had the density. So they put in the subways, all the mass transit systems that made sense that you need lots of people to justify those. I remember when we had the Claremont Hotel, I'd go down when I was little with my father, and A-Bag was in the lower levels. And I remember seeing, this is in the early 60s, and they'd have all these maps going out to 2020 and 2040, and it was amazing. You know, in 1960, think about 2040. You know? And I think the West is now choking on its success. And the Eastern Seaboard is also. In the end, I think the quality of life in the East is going to start rivaling and being better than the quality of life in the West because of the transportation issues. So let me give you an example. I have a cousin here, and his wife were living in South of Market, got married, had a baby. By the time they had the second baby, they moved over to Lower Piedmont, Oakland. Bought a house for $2.1 million. I can give you what it would comparably cost in all the other markets, but you know what the prices are here. And so I said, what's the commute like now? He says, well, you know, now it's a real problem. It's now taking me an hour and 15 minutes a day to come into town. And they're starting to live their life now around the bridge and Barton and so forth. Now, I think what's going to happen, I have this big art collection, and so I've got 100 exhibitions at 75 museums around the country. I do all these shows for free with Warhol and Jasper Johnson, whatever. So I go to all these cities I otherwise wouldn't go to. I mean, Omaha, Boise, Jackson.
I grew up in Omaha, Jordan. I grew up in Omaha.
Fabulous.
We're going to talk about Omaha for the next 11 minutes. So I think the football team would be pretty big.
I've been in Omaha, and Omaha sucks.
What I'm going to predict is that I think over these next 10, 15, 20 years, yeah, the younger folks, the millennials, are not going to put up with the kinds of commutes and the kind of cost in the coastal cities. And with the way technology is moving, and who knows what Google and Apple and those guys have in their future rooms in terms of holography and having meetings and so forth, I mean, amazing. I think you're going to see a big shift to a lot of people moving those communities where they're so much more affordable, you can do lots of things, and the younger folks all want to travel all the time anyway. So I think that in terms of an interesting, I wouldn't say threat, because the population in California is going to keep increasing anyway. But I think it's going to be a huge change. I think the Midwest cities, lots of tertiary markets, are going to become increasingly popular with an age group that won't put up with what all of you are now putting up with because you're too settled and seasoned in the markets that you're in.
Something very interesting got pointed out here, and I think I divide all businesses into two types. Number one is cost businesses, where your employees are a revolving door. You need a certain skill level, a certain literacy level, but employees are essentially interchangeable. And all those businesses go to places where there's less regulation, cheaper land, easier labor, all that sort of thing. That the warehouse operator who needs a forklift driver will get out of Dodge if at all possible. The other businesses are knowledge businesses, where the employers chase the employees. So George Lucas signed the world's worst lease at the Presidio in San Francisco, got his brains beat out by the best land use attorney in San Francisco, who was on the other side of the negotiating table, paid a huge ground rent for the privilege of building his own damn buildings. And why did he do that? Because he couldn't get animators in Omaha no matter what. The animators wanted to be in San Francisco. So you gotta look at a business as to whether the employees are chasing the employer or whether the employer is chasing the employees, which is what the last point was, is where do those people wanna live? Today they wanna live at 16th and Mission. When I first bought in the neighborhood of 16th and Mission, when I went around at night, I was armed. So, my wife and I bought an apartment building on 15th and Church, which was a block and a half south of Market, and our friends wouldn't come and see us because none of them had ever been across Market Street. And now people get out of Harvard and Stanford and they want to move to 16th and Mission. And so the employers are chasing the employees in that situation. And if the employees get fed up and go someplace else, the employers will follow them. No question about it. That's a very important distinction. All right.
With all the amazing stuff the Irvine Company's doing, and with all the stuff you're buying, it looks amazing. What are the target returns that you're looking at? You're doing development for all three of you in terms of, I mean, what is your unleveraged and leveraged return expectations? To get things approved and closed, to get Mr. Brand to say, let's do it. What are they? What are they?
Well, for Irvine, first of all, we take the long view, so we're not IRR driven. The company does not sell its properties. It's gotten to a significant critical mass to where it's self-funding and raising capital either by selling properties or bringing in outside investors is unnecessary. So focus purely on long-term yield. And in that regard, we're not different than the majority of the market. You know, I think development, we want to be between 7 and 8, stabilized between, call it, you know, on either side of 6, depending on where you are.
And that's leveraged or unleveraged?
We look at everything unlevered.
It's a return on cost. Good cash flow, you can see why. For us, I think it's timing. You know, traditionally we've been, you know, a value add buyer plus or minus 15%. But just looking where we are today, we've actually pivoted our investment strategy, and we're focusing now through a new fund purely on net lease income generating properties, just because reliable cash yield is so scarce in today's environment. And we're looking more with just very modest leverage at kind of a 10 total return, 6 current. Because it's just, you look in today's environment and it's hard to find a 14 or a 15 without taking undue risk. It really doesn't make sense.
Also, we look at everything unlevered as well, and we have a few different buckets of money. We do have 20+ billion in private capital that a fair amount of that does.
On which they do feasibility studies.
We do. So we do chase the core assets. Now, in today's environment, you made a comment earlier about the capital sloshing around. That our core money doesn't want to go chase to a 4 cap in LA, right? But so we do have them actually playing in some of the space that I mentioned earlier. Off the beaten path, you won't see these assets on our front page of our annual report, but maybe there's 200 basis point spread between the return on cost of a core asset and what we think we can get today in this, and then we think there's a lot more long-term upside, and maybe whether it be a land play or a conversion of some sort. So I would say there's very few core assets we've purchased in the last couple of years that weren't off market, and that comes from just boots on the ground, sending out a bunch of offers, trying to find maybe the 1 in 1,000 owners that doesn't know that if you just take it to the market and get 4 offers that your price is going to go up 14%. So I don't know if I answered your question like a politician or answered it exactly.
Well, he is publicly traded after all.